Hello, welcome to this presentation of the UK monetary policy. So let's move ahead and understand what this UK monetary policy is. So, talking about the government, the governing body, the Bank of England is the central bank of the UK, and the central bank of the UK is responsible, for setting an inflation target of 2%. So this is, the regulatory body in the United Kingdom that regulates the inflation rate of the country. So some of the tools that the Bank of England uses while setting interest rates uh, when inflation is above the target is uh, they may raise the interest rate to reduce demand and cool down the economy, and vice versa. Conversely, when inflation is below the target, the Bank of England may lower the interest rate to stimulate demand. So this is one of the regulatory mechanisms that is used by the Bank of England. So, one of the tools that I would like to highlight that the Bank of England uses is quantitative easing. This is another monetary policy that shall be explained further. Here, the central bank buys financial assets in order to increase the money supply. So, obviously, this in turn helps the economy. In addition to interest rates and quantitative easing, which is two of the monetary policies used, another factor that is used by the Bank of England is macroprudential policy, that is to promote the financial stability, which involves regulating the financial system to prevent excessive risks. So, it is worth noting that the Bank of England is operationally independent from the government. So, it is independent from the government and takes decisions independently. It's free to set the monetary policy, and it's free of any political interference as such. So that is the advantage. The government, the government's only place where it intervenes is where, if it believes that the bank is not meeting some of its objectives with respect to the monetary policy, that is when the central government will intervene with respect to the Bank of England's policies that it may set. Moving on. So the Bank of England's monetary policy aims to maintain the inflation rate at 2% through the use of the aforementioned techniques such as quantitative easing, usage of interest rate, and macroprudential regulation. These are the techniques used by the central bank. The UK monetary policy is focused on maintaining price stability and supporting the government's economic objectives. The Bank of England uses a range of tools, as already mentioned, that is quantitative easing, macroprudential policy, to achieve these goals. So let's talk a little bit more about the members of the MPC, which is the England Monetary Policy Committee. The MPC consists of 9 members, including the Governor of the Bank of England, three deputy members, um, three deputy governors, and four external members who are appointed by the Chancellor of the Exchequer. The MPC meets 8 times a year to review economic data and assess the outlook for inflation. So, moving on, the decision is made by a vote, with each member having an equal say. The minutes of the meetings are published a few weeks after each meeting. Quantitative easing. Let's talk a little bit more about this process. It involves, creating new money and using it to buy assets such as government bonds, and this increases the money supply in the economy, lowers interest rates, and stimulates economic activity. So, as already mentioned, the central bank uses macroprudential policy to promote financial stability. What does that mean? It involves setting of certain rules and regulations for the financial sector to prevent excessive risk taking and ensure the banks and other financial institutions are able to withstand some of these economic shocks. In terms of communication, they place great emphasis on transparency. The central bank focuses on establishing transparency. The governor holds regular press conferences after MPC meetings to explain the decision and answer questions from journalists. This provides greater transparency to the economy. Thank you. Thank you for watching.